Okay. What? Bring what? Bring what right now? Yeah. What happened to your group? Here, reach out to me as with you and the other person, reach out to me separately and we'll talk about what to do. Okay? Email's fine. Yeah. So don't worry about it. We'll figure something out. Put it face up. Okay. Is there any more quizzes out there? Please bring them in. Time is up. Time is up. That should be good. Okay. All there. Okay, so while we wait for people to come in from the other class, same rules as the previous quizzes, right? I'll let you know when the quizzes are ready. Hey, folks, if you want to talk about the quiz, please leave the room. Went all over. So there are a couple of things I want to do today. Folks, if you want to talk about the quiz, you can leave the room or you can stay in the room and listen, okay? The room or sit down. You can make a choice. You can either sit in and listen or talk about the quiz outside. Okay. So I will let you know when the quizzes are done. I'm not even going to open up packet 2 because there are a few more pages there. Hey, folks in the back, either leave the room or stay in the room and listen to the class, okay? Make your choice. I don't need to clap. Okay. Okay, so the gentleman in the white, can you get the gentleman in the white sweatshirt back there behind you? Can you get that gentleman behind you? Just pat him. Pat him, say, ask him to look forward. We're in class, okay? You want to have a discussion, please leave the room. Okay. So rather than open up packet 2, I'm going to kind of close up that IPO discussion by kind of framing 4 separate issues that kind of bring together, I think, the issues with IPOs. So last session, we talked about what you do in an IPO. You price the company, the banker gives a guarantee of the price. And because the banker gives a guarantee of the price, they tend to underprice things, which makes sense. In fact, on average, an IPO is underpriced by about 15%. How do we know that so precisely? How would you measure how much an IPO is underpriced by? Sophia? On the first day of trading, you look at the open of trading because the banker sets a price when it opens. If it's underpriced, the price jumps on average about 15%. You ready for the first question? And I think we kind of answered this last session. Why can't we make money by buying every IPO then? On average, you should make that 15% jump, right? What do you think? Why is it so difficult to make money?
Be very volatile.
I can live with the volatility with an average jump of 15% in a day. I mean, I have a lot of, yes, that's even better, right? You make the money here. We're not playing an intrinsic value game. We're playing a trading game. You buy every IPO. What are you going to do? Hold it through the first day, sell it at the end of the first day, and collect your 15% jump. Yes. Okay, here's the first thing. You ask for 1,000 shares in every IPO. I could give you the list. In fact, I'll give you a website today which lists out every IPO that's coming for the next 6 months. So you put in a request for 1,000 shares in every single IPO. Will you get 1,000 shares in all of them? How are the bank? So let's say the bankers don't play, favorites, which they sometimes do. Let's say it's unbiased. How do they decide how many? It's not even about you, right? So what does the banker see? He sees the number of shares he's ready to offer, 1 million shares. There are 3 million people asking for shares. He can't give everyone what they asked for. You're going to get 1/3 of what you requested. So you're going to get 333 shares in that company. Next company, let's say you have 1 million shares and 2 million subscriptions. You're going to get 500 shares. Are there some companies where you get all 1,000 shares that you asked for? Yes, Sophia. In fact, they're going to drop. So on those companies where you get 1,000 shares, you say, I wish I hadn't got those 1,000 shares. You see what's going to happen to your portfolio, right? At the end of the game, you're going to have a portfolio that's overweighted in overpriced IPOs. You're going to get 1,000 shares and underweighted in the IPOs you really wanted. You're not the first people to think about, hey, I can make money. There were funds, mutual funds that were started after these studies came out, say, this is an easy way to make money. We'll just buy every IPO. And at the end of the year, when they looked at the returns, they discovered they were making what everybody else was making. So the first thing of why don't people exploit the underpricing? The answer is easy. It's not easy to exploit. I have a second question. Let's say bankers are open about the fact, and they are open that they're going to underprice the offering by 15 or 20%. Who loses from that underpricing? Whose money is it that they're giving away? The founder and VC money, basically they're leaving money on the table, right? So let's say you're the founder of a company or the VC invests in the company and I'm underpricing your offering. I am taking your money and transferring it to the people who get those shares. Why are you okay with that? Sophia? You're getting liquidity, but you might not care about liquidity if you're selling all your shares, right? So the initial offering was you are selling all of the shares you have as a founder. Of course, you're going to be pissed off. But this is the same thing. If I'm selling all my shares, I don't care about momentum. But if a founder is holding, no, no, that's too messy. The tax guy will get you. You're thinking too messy. Most offerings, you know what percentage of shares get offered on the offering day? Less than 10%. You see how the founder's mind works, right? If you're a founder of VC, you're okay leaving money on the table on that first 5 or 10% because you hope to sell your shares 6 months or a year from now because you're actually locked in. You can't sell right now. What you want is that great story the next day in the Wall Street Journal that says stock price jumps 50% on IPO. Who reads that story? Sheep. And what do sheep do? They do what other sheep do. You're hoping that that story will draw other people into the stock. And that'll push up the price even more. It's a dream that you have that 6 months from now, when you try to sell your shares, you're going to get a higher price because the momentum. That wasn't always the case. When Apple went public, 60% of the shares owned by VCs and founders were offered in the offering. In the 1980s, much of the company was made available in the offer. When Facebook went public, less than 10% of the shares did. So why do founders and VCs accept it? Because to them it's a small slice of a very big pie and they're playing the long game. I have a third question. Okay? I told you the typical structure for an IPO. The IPOs, private business goes to a banker. Somebody help me with all of the things that the banker does in return for that 6 or 8, because they get a pretty hefty slice of it. What are some of the things about going? They underwrite, they guarantee a price, but that's like a realtor guaranteeing you a price, but not telling you what the price is, right? They guarantee a price, but it's set too low. They market it, right? Basically, one thing they do is they market your company, and if company people have not heard of your company, so the roadshow. What else? So they do marketing, they do pricing badly, but they do pricing. What else do they contribute? You're a young unknown company. You pick Goldman Sachs as your banker. Why are you doing it? Or investors say if Goldman Sachs is taking the company public, there must be something there. It's a complete lie, but you believe that, right? They bring credibility. And finally, in the post offering, they offer you support, price support, which is not huge amounts. They don't have the cash, but they'll keep your price from dropping by coming in and buying shares. Morgan Stanley did this with Facebook in the first 2 weeks after, because the offering did not go well. Those are all big deals 50 years ago, 40 years ago. Why? Because the company going public was relatively unknown. And if Goldman Sachs or Morgan Stanley did not take them public, people say, I'm not buying shares in that company. I don't know what's in the company. This is like the good housekeeping seal, right? The bank. But each of those things that bankers do has become less valuable over time. Let's take the marketing, the roadshow, right? One celebrity endorsement for your stock can cover what 50 roadshows. So you get LeBron James to say buy the shares in the company, people are lining up. The marketing part has become much more diluted. You don't need the investment banker, you just need social media, you need other ways to get it out there. I talked about companies that are unknown, and the banker is the reason people learn. When Facebook was taken public, Morgan Stanley was its investment banker. I'll wager that on the day Facebook went public, more people had heard the name Facebook than the name Morgan Stanley. For some companies, you don't need an investment bank say, let's tell the world who you are. If you're a high profile company, Uber going public, by the time it went public, we all had Uber on our phones. We knew exactly what it did. Sophia? How about Palantir? Let's pick any high profile company, Peloton. I would argue that in most of these companies, you don't need the investment bank. You have the prospectus, you know what the company does. The advantage you get from an investment banker offering that seal is less valuable now than it used to be because we have more access to the information, we have more news, more data. Third, we talked about the credibility effect, right? Which is you lived in the reflected glory of a Goldman Sachs. Those days are done. Now I'm not sure if attaching Goldman Sachs to myself lowers my credibility or raises it, right? This is the post 2008 world we live in, where investment bankers are not up there in the esteem standings, they're down here. What I'm trying to say in a long winded way is all of those things that bankers bring to the game is getting less valuable. So something's got to change in the system, right? So what's the first thing that can change? That 6 or 8% fee should become 4, 3, 2, 1%, right? You're not providing as much. Second, do you actually need to set an offer? This seems very artificial, right? Set an offering price and then open to trade. Could you skip that offering price and just go directly to the market? You could do it. In fact, Google was one of the first high profile companies to do it. They said, we don't need a banker. People know who we are. Why the heck would we need Goldman Sachs to tell the world what we're worth? We're going to open to demand and supply setting the price. Nothing's left on the table then if you're a VC or a founder. It's called a direct listing. The question is, why don't more companies do it, especially high profile companies? Very small company, people don't know about, you might still need the banker. Why don't more companies do direct listings? Bill Gurley, who is a partner at Benchmark Capital, we talked about him in the context of Uber, has been a strong proponent that more private companies should use direct listings. You know the problem with direct listings is? Anybody? It's not that you can game the system because bankers game the system. So what difference does it make who games the system, right? There's a problem with direct listings that the SEC has put a restriction on direct listings. If you do a direct listing and you raise cash, remember we talked about the three uses you can have for cash. You can use it to pay, let equity investors cash out. You can use it to keep in the company, or you can use it to pay down debt. If you do a direct listing, only the first option can be used. In other words, it's got to leave the company. So if you're a growing company, you're doing an offering because you want to have the capital to cover your reinvestment needs, a direct listing doesn't work because of those restrictions. Don't ask me why they have the restrictions. I think they should be removed, but they're still there. So direct listings have never taken off. Yes. No, no. Remember, you can't be held liable for things that are not fraud, right? I mean, the Delaware courts essentially have ruled that you can't be held liable for not meeting estimates. You can't be, unless they show that you cooked the estimates and you committed fraud. So I don't think that's going to give you any legal cover. Even having a bank won't protect you because the projections are still coming from the company. So you're not any more or any less exposed. They can sue. I mean, this is the United States of America. You can sue anybody on any given day for anything. Doesn't mean you will win. To win on a business thing, you have to show not just negligence, not just that you didn't do your job, but that you committed outright fraud. That's tough to do. So direct listings haven't taken off, but in 2019 and 20, you had a question about direct listing? Yeah, exactly. Exactly. So you cash out as owners, right? Spotify is a classic example. So in 2000, so direct listings haven't displayed, so people are not happy with the banker-led IPOs. Direct listings haven't taken off. So in 2019, a third structure opened up. Anybody know what it was called? SPACs. Anybody want to describe to me how a SPAC works? Want to try? So you're going to create the SPAC. So let's go out and create the SPAC. So what is a SPAC? So you list it. So no, remember, you've created the listing. So you go public without any business. You're saying, why would I do that? Right? Just for the same reason you invest in a private equity fund, right? You're investing so you collect the cash. So you now have a publicly traded shell company whose only asset is cash. You're saying, why would I do that? You have a window. It's 2 years, 3 years. And during that window, what do you try to do as the person running? You In other words, instead of having the private company go public, the SPAC buys the private business. And the minute it acquires the private business, that private business now inhabits the shell company. So you're a software company. The minute I do the SPAC, the software company now trades as the original SPAC company did. You filled in the space. The question is, what are the costs and what are the benefits, right? You're investing your money in a SPAC. The SPAC founder, creator, takes your money, and here's the first problem. They take 20% of your money right off the top. Where did the 20 come from? They probably stole it from the hedge fund guys who do the 2 and 20. Let me take 20% off. So if they raise 100 million, 20 million goes into Chamath Palihapitiya's pocket right there. Right? You got 80 million now left, still in cash. You're saying, why would I leave Chamath with my 80 million? I never would, but clearly people are. What are you hoping he will do? What is his reputation? And why do we think he has the capacity to do that? He's a smart guy. He has a podcast. He used to work at Facebook. Was it I mean, basically, he has a tech background. And what do you think all of this will do? That he will find this great little tech company and buy it at the right price. That's a lot of ifs along the way. And if none of that turns out, one of the protections you have in a SPAC is you can take your money back at any time. So basically, it looks like an easy play until you factor in the 20% loss and the fact that Chamath might not work in your best interest. He might not even know how to value companies. He might be picking companies, overpaying for them. A SPAC is almost designed to blow up because of that 20% slice. But it doesn't have to be 20%, right? Bill Ackman created a SPAC with a 6% slice. And now we're talking about an interesting structure. Because you might say Bill Ackman is a great private equity investor, he knows what he's doing. I mean, let me ask you a question. If Warren Buffett had created a SPAC 20 years ago or 30 years ago, do you think people would have invested in the SPAC? Absolutely. You can see a SPAC structure might work for a very special investor who doesn't take 20% but takes 3 or 4 or 5%. So we're, I think, in this strange place where the old way of doing things is no longer working. We're trying new ways, the SPACs, direct listings, they're not gelling either. But one thing I can guarantee going forward, I think the way companies go public is going to bifurcate. If you're a company like Google or Facebook or Twitter with a high profile, I think you're going to go the direct listing route. Cut out the middleman because he's not doing much for you. If you're a small company and people don't know much about you, you might still go with the banking structure, but your fees are going to be structured to how much work the banker puts. It's almost like, you know how, when you buy a house, the way in which realtors get compensated in the United States makes absolutely no sense. How much when you buy or sell a house, what happens? And the commission is actually 3% on each side. And it used to be 3% each side, whether you had a $100,000 house or a $10 million house or a $1 billion house. I don't think anybody has a $1 billion house. It was an absurd system. That system is obviously under tension, but look at how much they're holding on, right? You got a Supreme Court ruling now against the way realtors set fees. You got Zillow and Redfin trying to take away the business. But inertia is a nasty beast. It just hangs in there. This is not going to change overnight, but the way we do IPOs is shifting. But now I want to talk about something else that has shifted in the IPO process. In this graph, I've actually listed out the typical characteristics of a company going public each year starting in 1980 going all the way through 2020. Let's go back to 1980. Typical company going public. Apple went public in 1980, for instance. Had revenues of 50 million. And 90% of companies going public in 1980 were making money already. Positive net income. The typical company going public in 1980 was a small company with a working business model. Let's fast forward 40 years. Typical company going public has revenues of almost 100, so much more in revenues, much larger company. But here's the other statistic. Less than 20% of companies were making money. The typical company going public in 2020 was a much bigger company without a working business model. God help us. Right? This is the effect of VCs scaling up companies without building business models. The type of company going public has become larger. So how can companies get so much larger now? What has happened in the rest of the market that's allowing companies to stay private and become so big? Do VCs have a lot more money? Yeah, maybe a little bit, but not by that much. So what's happening in that space that's allowing a private company to continue to raise capital that they couldn't do 40 years ago? But still, they have limited capital, right? So where's the extra money coming from? Yes. Still VCs. That's just a subset of VCs. No, that'll be a terrible way to raise capital. You'd go bankrupt, right? There's VC debt, but that's not a big chunk. Yes. You know, take a look at how Uber raised capital in 2014, 2015, 2016. It wasn't VCs anymore. 2016, it was a Saudi investment, sovereign funds. Fidelity and T. Rowe Price, public equity investors, were investing in private companies. We've created this gray space where private companies can now raise capital from investors who weren't in that space anymore. What does it mean? Effectively, you can get much bigger as a private company. Think about it. You're now getting the best of both worlds, right? you're able to scale up, but you don't have any of the disclosure requirements and the corporate governance requirements of being a public company. You get to be a 10 billion, $20 billion, $50 billion company before you go public. And as this has happened, the other statistic is fewer and fewer shares are being offered on that first day of trading. So instead of 50, 60% of the shares, 10% of the shares are being offered, which means you're going to get less care about the pricing because it becomes almost like loss leaders in a department store. You know what loss leaders are? That table full of cheap things, and they suck you deeper and deeper into the store and leave you by the Ralph Lauren section where you overspend. Basically, they're drawing you in with that underpricing. So one final thing before we put this to rest. We've talked so far about IPOs and public companies, right? Let's say you start a private business, you're a founder. Initially, where does your capital come from? It comes from you. Completely undiversified. That total beta we talked about kicks in. Let's say you succeed in terms of growing your firm. Things are going well. What's your next step? You don't go public, you go to venture capitalists. Venture capitalists are a little more diversified than you are. Why? Because they own 15 or 20 companies in a sector. Angel financing. Angel financing tend to be focused. Little more. So what does that mean? Your correlation with the market goes up, your total beta comes down. You keep growing, you now approach private equity investors and maybe bigger venture capitalists, even more diversified. Their correlation with the market is now 0.7, 0.8. The total beta comes down even more. And then you finally go public, at which point, what do? You have a market beta. You see how this is going to play out in a discounted cash flow valuation, right? When I do a discounted cash flow valuation, my total beta will shift for my company, especially if I think this company has great potential. Early on, I'm going to use the total beta. Why? You're the founder, you're the only person investing in the company, you're not diversified. As you approach venture capitalists, I'm going to use a much lower beta because the correlation, it's the same company, same business, but because the investors are more diversified, my total beta decreases. And by the time I go public, my total beta is equal to my market beta. My cost of equity goes from 24% early on, when I'm the only investor, to 14% when venture capitalists enter in, down to 9% when it becomes a public company. So in my discounted cash flow valuation, there's my cost of equity line. When my discount rate changes, remember, it's going to have consequential effect on my value. And in this case, the correct value for the company is $1.5 billion if I do things right. I would challenge you to actually find private company valuations where people actually do this. You know what you'll tend to find? They'll either use the 24% all the way through, in which case, what are you doing? You're penalizing the company because you're attaching a total beta for an undiversified investor all through its life, including the terminal value. The value that you get is 1.2 million, much lower than it should be. Alternatively, there are other people who are in denial, who act like it's not a private business. They go directly to the 9% cost of equity and use it all the way through, in which case you're going to overvalue the company. So Goldilocks scenario. You want to bring in the fact that investors are not diversified right now, but you also want to factor in that that will shift over time as the company gets bigger and is able to attract more capital. When you think about valuing private companies, that's something that you have to factor in. But there are implications if you take that to the next step. If you're valuing a private business, it should have more value if you're in a sector where companies are more likely to go public. Technology companies. When I value private technology companies, the penalty of that total beta dissipates very quickly because most technology companies tend to go public. You own a hardware store? I'm not scaling you up and taking you public because how the heck am I going to do that? You're not the Home Depot. So in some businesses, this effect is going to be much greater than others. You're a private business in a market where it's difficult to go public. I will value less than if you're in a market where it's easy to go public. One of the advantages of being in the US market is you have that exit strategy of being able to go public. You know how few tech companies in Europe actually go public? I would value a tech company in Europe a lot less than a otherwise similar tech company in the US. So you know what tech companies in Europe do? They list in Silicon Valley, right? It's almost uh, guaranteed to happen if that's the case. So when you look at private companies, that is the transition you're trying to bring in. And the easier you see the transition to being a public company, the less you will penalize a private business for being private. So that when you think about total beta, keep those things in mind. So let's summarize. You're valuing a private business, motive matters. You need to tell me why you want to value before I can even get started. Whether it's for taxes, a divorce court, or for a transaction. You need to tell me who you plan to sell it to. You also need to figure out what kind of buyer is interested in your company. Is the buyer diversified? Because that's going to affect. Do you see what this means, right? In a private company valuation, you need to have a much longer conversation with the person that you're valuing the company for. And that's a good thing because ChatGPT might not be able to do it. There are far more to add to the process in a private company valuation. So as you look at private companies, don't create new rules. It's the same process. And the question is, how do you adapt the process to deal with the fact that you can invest your money elsewhere? Yeah. No, I think I would value it as a part because the marginal investors who trade the stock and drive the price are still the diversified. And the only thing is, I tell the family, your job is to keep investors happy, not the family happy. Right? And that's a big deal, right? Because families say, what's good for us? And I said, look, you've gone public. This is not about you. You want to maximize your wealth. You got to keep the institutional investors who are the marginal investors in your company happy. Really tough to do in family businesses because they think, oh, it's our wealth. I understand, but you still have to run the business for those investors because they're the ones who set prices. Mark Zuckerberg has to worry about what Fidelity thinks about Meta far more than what he thinks about Meta. And that's mindset that's actually tough to develop if you're an entrepreneur because you got to think about those outside investors. So I'm going to close up packet 2. And even if you didn't bring packet 3, I will at least get started because, and I want to start with a very simple review of basic option pricing. I know you guys have all mastered option pricing. You know the Black-Scholes model inside out, but I'll act like you don't. And let's start with the very basics. This next section of the class, we're going to talk about what are called real options. And I'll be quite honest, real options have become a buzzword. Consultants use it, bankers use it. They use it to justify a premium. Remember the weapons of mass distraction? It's become a weapon of mass distraction. So I'm a skeptic. When people say real options, I have some questions to ask. And I want to give you those questions because people are going to throw real options at you. And I want you to be able to separate the wannabes from the options that have truly have value. So let's set the table. You remember in corporate finance, you computed the net present value of a project. You took the cash flows, you discounted them back at the right cost of capital, you compared the initial investment. And what's the rule with NPV? For a project, if it's positive, you take the project. If it's negative, you reject the project, right? That's basic capital budgeting. All of corporate finance is built around that. When you do a net present value for a project, you're asking the question, is this a good project today? And it answers that question, right? Positive net present value, good project, negative net present value, bad project. But here's what you might be missing. Let's say you have the rights to this project for the next 10 years. You computed the net present value today, you came up with a negative net present value. Are the rights to this project therefore worth nothing as well? Why might the rights have value? If the net present value is negative, why would having the rights to this project for the next 10 years have value? That's a very convoluted way. It's very defensive, right? There's actually a more aggressive way you can think about it. The project has negative net present value today. Let's say it's a non-viable technology in AI. Could the technology become viable 2 years, 3 years, 4 years from now? Markets can change, costs can change. There's an option here. An option, if you wait, this project that's bad project could become a good project. We're going to use this. to talk about why patents can have value even if they're not viable. Technologies can have value even if they're not viable. Oil reserves can have value even though the oil price is too low today. Second stop. It doesn't reflect the fact that as the person running the project, you can adjust how much you produce based on something you see. I don't want to be mysterious, but let's say you're valuing an oil reserve. There are 150 barrels of oil under the ground, 15 years to get it out. So you say 10 million barrels each year. Basic math, right? You take the cash flows. What are we missing when we do that? Are you locked into producing exactly 10 million barrels a year? In fact, why might you produce more in some years and less in others? Because you'll check the price of oil, right? If the oil price is $100, you might produce 15 million barrels. The oil price drops to 40, you might drop to 5 million barrels of oil. If you can adjust the production schedule, you can increase the value. We're missing that with the traditional discounted cash. That's an optionality. Third stop. Let's suppose you're investing in a big market. Give the big market name, AI, China, India. And you do your initial analysis, you come up with a negative net present value. So what does it tell you? Don't go into that market, right? But let me play devil's advocate. Let's suppose by taking this investment, which has a negative net present value, so we're not debating it, there's a chance that if this investment works well, you have the right to expand into the rest of the market. Remember, it's a much bigger market. Right now, that right is worth nothing. But there's an option here. It's an option to expand. Option to delay, option to adjust, option to expand. And here's a final option. Let's say you're an infrastructure company. What's a typical time horizon for an infrastructure investment? 30 years, 35 years, 40 years, right? And you make a big upfront investment. And you have cash flows that you hope will cover that initial investment. You go in expecting a positive net present value. Is it possible that the cash flows could disappoint you? Yeah. And if you're locked in for the next 35 years, you're now collecting probably negative cash flows for the next 30 years, unless you can walk away from that investment. It's called the option to abandon, where you say, look, no, we built this theme park expecting positive cash flows. They're now negative cash flows. We're going to shut the theme park down, turn it into parking lots, and get what we can. These are all options that are all being ignored when you do a traditional static analysis, which is what a net present value is. So to understand where the value of real options comes from, I'm going to go back to a very simplistic example. So decision tree. 50% chance of making 100 million, 50% chance of losing 120 million. Would you take this investment? What's the expected value? Minus 10, right? I'm going to do some magic here. So does everybody get the minus 10? 50% of 100, 50% of 100. I'm going to take that same investment and break it up into two subparts. So first you take an initial investment where there's a 75% chance of making plus 20 and a 25% chance of losing 20. If you make the plus 20, you follow up with a second investment where there's a 2/3 chance of making 80 and a 1/3 chance of losing 100. You add up the losses, 100 minus 100 minus 20, that's minus 120. Plus 20 plus 80, I'm sorry, that's the plus 100. In terms of the total upside and downside, it looks exactly the same, but here's the magic. If you take the expected value of the second investment, it's positive. So what is it about the second investment that's turning a bad investment to a good investment? In other words, there's learning from the first. It's like a test market, right? If you get a good outcome in the test market, you invest the extra amount, you learn, and you change the way you behave. So if you get a bad outcome, you don't invest. The building blocks for real options are learning and adaptive behavior. Remember the oil company? Where did the value of the option come from? They observed the oil price and then they changed how much they produce. If they produce the same number of barrels of oil, no matter what the price was, there's no optionality. Learning and adaptive behavior. You're going to see a lot of real options wherever you go to work, people who throw the word around. So I'm going to give you the 3 questions you need to ask and answer before you start to attach premiums for real options. First, You got to ask, when should we even be talking about options? And I'm going to argue that a lot of the time people throw the option word and you look and say, there's no option here. So we're going to talk about what is it that makes an option an option. Second stop, we're going to ask, when does that option have significant economic value? When should I spend the time and the resources trying to put a number on it? And I'm going to give you a magic word to ask, to look for when you look at options. And third, when can I use an option pricing model to value the option? So let's at least start with the first part of it. When is there an option? When you think about options, they're classified usually under derivative securities, right? What does that mean? Derivative securities. Yes. In other words, they're leeches, right? They can't live on their own. They need an underlying asset. The first thing you look for in an option is, what is the underlying asset? Second feature of an option is the cash flows are contingent on something happening. With a traditional call option, the stock price goes above the strike price. So you got an underlying asset, you got a contingent cash flow, and usually options have a limited life, 2 years, 4 years, 5 years. So I'll end today with payoff diagrams I'm sure you've seen in your foundations class, your corporate finance class, which kind of separate options from every other physical asset. This is what an option payoff diagram for a call option looks like. There's the contingency, right? The stock price exceeds the strike price. Stock price exceeds the strike price, you make the difference. If not, you lose, but you lose only what you paid for the option. Your losses are limited. If you have a put option, the reverse is true. The stock price drops below the strike price, you make money. But the key word is what you lose is always limited to what you have paid up front. When we start next class, we're going to use that feature of option to talk about what drives the value of an option, because it's going to show up in your option pricing models in terms of how we think about risk with options very differently than how we think about risk with almost every other asset class. So I will see you on Wednesday, and I will let you know when the quizzes are done so you can come pick them up. And tomorrow, I'm going to send you an email about the project listing with a to-do list so you know what needs to be mopped up. And I'll also follow up with the email about the final exam and all the specifics about it.